A monthly series sponsored by Jeffries and Company. I want to thank Stephen Glenn for all of his work in organizing today's event. Our topic today is human capital. Michael Milken spoke here some time ago, and one of the things he said was that very few companies put their human capital on their balance sheet, which is ironic considering that in this so-called new economy, human capital is probably one of the most important investments. And that got us thinking about this whole topic. That's why Steve chose this as our topic for today. Gary Wendt put it more succinctly. He said the brains have become more important than backs. So we're very honored to have two very distinguished panelists to discuss this topic today. Sitting next to me is Gary Becker, who is a professor at the University of Chicago. He writes a monthly column for Business Week and is the author of a book entitled Human Capital. And so thank you for coming so far today to be with us. Gary Wendt is the retired CEO of GE Capital and now sits on the boards of several internet companies, and then the rumor has it that he's starting a fund to invest outside the U.S. The Greenwich Roundtable has always strived to be on the forefront of intellectual and investment ideas. On the intellectual side, we originally hoped to have Regis Philbin here, host of the hit new TV game show, Do You Want to Be a Millionaire? He couldn't make it, he was taping a show. On the investment front, I was trying to get a hold of Warren Sulmacy, president of Harbor Securities. He wasn't returning my calls. And then I saw this article in yesterday's paper, Trader's Loss Threatens to Shut Down Broker. Apparently, Harbor Securities, a day trading firm, it literally rents out its balance sheet to day traders, and unfortunately one day trader who was short broad vision, long technical, you can imagine what happened, so he couldn't make it.
Do they live in Greenwich?
It's your neighbor. Anyway, so I'm sorry they couldn't make it, but we do have two very good speakers on this topic. Regis suggested something. He said he was trying a new format for his show, and he said, try this. He said, give the panelists two questions, and they have their choice of which one they want to answer. So, panelists, can you answer one of the following two questions? Please, no help from the audience. Which of the following four races is longest? The Iditarod, the London Marathon, the Indianapolis 500, or the Tour de France? Or, the second question is, what is human capital?
Tour de France.
Gary, you are our new $1 million winner. Congratulations.
All right.
Professor Becker, why don't you start us off on this
topic? Maybe I'll stand up so I can see some of the people who are in the back, and I think people can hear me without the microphone. Well, it's a pleasure to be here. We're kind of an odd couple. We come out of different backgrounds. I think we complement each other very well.
Same name.
Same name to start with, right? And I recently was at a meeting with Mike Milken, who had been here. And I said, we've both been talking about human capital for a long time, but he's made a lot more money out of it than I have. Now, what is human capital? This is a word that, when I wrote this book in the early 1960s called Human Capital, people didn't know what it was. They thought it was really demeaning to talk about people in the form of capital. So I think it's worth first starting out to make sure we all understand what is meant by this term. And the word human and the word capital both enter. It really has to do simply with the education, the skills, the training, the knowledge that people have. Now, it's human because it's part of people. It's unlike machinery, you can't separate them from it. And it's capital because typically, while the knowledge we acquire doesn't last forever, it becomes obsolete, and I'm going to come back to that point. It has a long life. What we learned in college and universities, we may have forgotten a lot of it by the time we get older, reach my age, but some of it is retained. and we keep with us. And that's the capital aspect of it. Now, the reason it's receiving so much attention is that modern economies, they're not based, as it's obvious, on strength or land, to some extent even equipment, although equipment is clearly important. They're mainly organized around how to utilize effectively the skills and knowledge that people have acquired. Modern economies in the aggregate command an immense amount of knowledge. Each of us has, no matter how informed and how varied we are, we each have a tiny, tiny component of that knowledge. So what a good economy does is take the knowledge of each individual, each company, and combine it together in some effective aggregate. And there are a few statistics that will indicate how important human capital is today compared particularly to what it was in the past or in less developed countries. When we think of the capital of an economy, we usually think either of the financial assets, the value of securities on the, say, the various stock exchanges in the trillions of dollars, the physical assets that underline these values, the plant and equipment and the like. And those are all important, of course. But they're dwarfed in magnitude by the valuations that are placed on the education and training people have. Now, there's no market where you can go out and see these values. So it's up to economists like myself and many others to try to estimate these values from earnings and other bits of information that we have. And a number of economists have worked a lot on this question. Their estimates suggest that roughly 65 to 70, maybe 75% of all the capital, truly defined, accurately defined, all the capital in an economy like the United States is in the form of human capital, not in the form of assets. They will make up the rest of the capital. It'll be mainly education that people receive, the training that they receive, and the like. Another way to look at that is to ask, how much of our GDP or GNP is invested in various forms of human capital? Now, the three most important forms are education, on the job, and other forms of, adult training and health. And we know how much is spent on education, roughly 6 to 10% of GDP. And on-the-job training, I'll come back to that. We only can guess at that because, unfortunately, businesses do not keep accounts where they separate out their human capital accounts. But the best guesses are maybe 6 to 8%. And health, we know that roughly 15% of GNP is spent on health. Of that component, a good 6% is really capital investment as opposed simply to maintenance. So I'm leaving out other forms of adult training and the like. These three components alone, as you see, is about a quarter of GDP. So when we talk about how much is invested by the United States, we grossly underestimate the investments by concentrating alone on physical investments. We more than double, I think, the total investments when we include human capital. Another measure of the value of and the growing importance, and this really gets more explicitly at the growing importance of human capital, is if you look at the premium that people receive in the labor markets, business markets, as executives, as workers, and the like, the premium that more educated people receive compared to less educated. Simple measure of that would be the gap between the earnings, let's say, of people who have some college or university education and high school graduates. Now, around 1960, that gap was of the order of 40% on the average, because it varies a lot from person to person. Some people drop out of high school are worth hundreds of millions, and other college graduates can barely get by. So there's a big variance in this. It's misleading to tell somebody go to university and you'll do 40% better than if you went to high school. That's not true. But on the average, it's a very persistent gap that's found all over the world. It's not unique to the United States. People have studied this, the effect of education on earnings for maybe 100 countries of the world. And generally speaking, this gap is large in every country that's ever been studied. Generally somewhat larger in less developed countries because they don't have many highly educated people. But it was sizable in the United States until 1960. And the remarkable trend since 60 has been that this gap has exploded. From 40%, it's now of the order of 65 to 80%, depending upon exactly who you count in the college-educated population. And there's a gap, not comparing all people who didn't go to college, but high school graduates alone. So it's an enormous gap. It explains why many more people in the United States are now attending higher education than they did in 1960. And this is all ethnic, racial, sexual groups, and the like. An explosion. And that explosion is a reflection, we believe, by we I mean economists who are studying this problem, of the growing importance of human capital in the modern economies for reasons that are pretty obvious. Now that's at formal education. When students come out of universities and colleges, however, or high school, they have some general information, and the purpose of, as a university teacher for a long time, the purpose of a university is generally to give people basic principles, basic knowledge, that they will then convert into more specific knowledge as they go to work for particular companies through training and learning and the like. I mean, I think that's the basic educational purpose, to give them this knowledge that's flexible, that can adapt in a moving economy like ours has been and will continue to be to new circumstances. It then is up to companies to take this sort of raw material that they get and convert that into usable employees of productivity that are useful to companies. Now, unfortunately, the amount that's done at the company level is the hidden component of the human capital investment. Very few companies have any explicit accounting for this capital, mainly because due to tax laws they can write this off as current expenses. They don't have to have a depreciation on this capital. It's a current expense. And so it shows up to the extent it's useful in companies, and it's a major asset of companies. It shows up in goodwill and other residual accounting categories rather than in an explicit category that you can go to and see plant, equipment, inventories, and then human capital. You don't have that component typically. But so we've had to, economists who worked on this have had to estimate this by various bits and pieces, individual studies, etc. I won't go into the gory details of how this is done. And they're just estimates because there's no direct evidence on it. But these estimates suggest that the magnitude spent by companies that are affecting the valuation of companies, the stock equity values and the market worth of companies, is enormous. Some estimates make the total investment by companies as large as the total amount spent on education, say in the United States. I'm speaking now in particular for the United States. Others come up with maybe 50% of the total spending on education. But either estimate, even taking the lower range to be conservative, this is an enormous amount that's being spent by companies, not being priced out explicitly. I hope it's being managed effectively, but it's far easier usually to manage an asset when you know exactly, you have a good, clear measure of what you're doing. And unfortunately, we don't have that. Countries don't have it. It doesn't enter into any national balance sheets directly, but it does enter into the worth of firms. Now, I believe that it's possible to develop explicit accounting for human capital, that we don't do it not because it's not feasible to do it. I think it is feasible to do it, but there's no tax pressure to do it, as there is for other forms of capital, where you have to have an accounting for it, and you have to, because you're only allowed to depreciate at a certain rate, and you have to show that on your sheets and the like. You don't have to do that for human capital. But in principle, there's no intrinsic difficulty in getting a value on that and showing exactly what you have. Now, given its importance in general, one would believe that and you're mainly investors here. I'm not an investor. I live in the ivory tower, so I have to convert my ivory tower into what might look more practical. But as investors here, one would believe that companies that are going to succeed and have succeeded in this highly competitive environment that we have not only in the United States but more on a global basis will be those that are very cognizant of the importance of investing in their workers, cognizant of the valuation produced by this unpriced, unexplicitly measured human capital, and manage it appropriately. Now let me make one other point. As the growth in the value and significance of human capital, both in schools and on the job, has emerged and continues to emerge, an issue develops that was less important in the past. Traditionally, most companies provided their own training because it was of smaller magnitude than it's becoming. And they had, of course, first-hand knowledge of their workers and what might be necessary for training their own employees. That's still going to be a major way this is going to be organized. But with the growing importance of human capital, the rapidity in some sectors of technological change, human capital, like other forms of capital, becomes obsolete and depreciates. And it's always been necessary to have some provision within a company or independently of the company for sort of maintenance and reinvestment in your human capital. As an economy becomes more knowledge-oriented, the process of investing in human capital becomes more a lifelong rather than a period, an activity that you engage in when you're young, and then when you get older, you sort of use up or you live off of your human capital. That's partly true still, but it's also increasingly true that if you don't maintain your human capital, you become obsolete. And that's true in a lot of areas. It's true, let's say, my own professional field of economics. If I hadn't been continuing to invest in what I know about economics since my graduate school days, I would have been obsolete today. I couldn't really have participated actively in the research or other environments. And that's true increasingly in many professions. So companies recognize that and, of course, try to maintain the activities and the up-to-dateness of their workers. But new companies are emerging now in larger numbers that specialize in the activity of providing human capital, refresher courses, new information, maintenance courses to employees of companies. And I'll get a plug-in for my one little venture. I'm on the board of a small startup, which is an internet learning company called Unex.com. And its sort of plan, a business plan, is to go from our company to other companies. That is to have companies provide employees for, let's say, fields like finance, Black-Scholes option formula. Some people find that useful to know what that means and how to price options. Basic accounting techniques. They may discover they need accounting. Economics. On a global range, probably the most popular course in the world is learning English. Bring English to a lot of companies, employees whose English is imperfect, and so on down the line. Now, the role of the Internet really links up with one other major aspect of human capital that is worth emphasizing. The most important cost for individuals, for companies, of investing in human capital is the time of the people involved, particularly of the student. Now, we've estimated, let's say, that if you look at the cost of education in the United States, more than half of it is due to the fact that people are in school rather than out working. Now, this cost never enters into national income accounts, let alone in anybody else's account. It should be, but it's part of the real cost, the real expense that is made in investing. And similarly for training by companies. Now, often what companies have done is say, well, we'll take some executives, we'll send them to University of Chicago, Harvard, Wharton School, etc., for some executive training and other courses. And that's still going to continue to be done. What the Internet, however, allows you the opportunity, at least, and this is still in formative stages, is to bring the learning to the student rather than bringing the student to the site, bring the virtual site to the student. At least that's the plan of UNEX, is to use the Internet in a very substantial way to provide courses in the various subjects that I mentioned and a variety of others that will be developed. And I think its main purpose is not that this is simply a new medium that can be used effectively, but it can be used effectively to help economize on the time of the people, the adults, the employees, the executives who are involved in getting this additional learning or getting up to date on materials in areas that they know. So that's going to be one, I think, of the major changes that's going to develop in the way human capital is delivered. There's going to be companies, and already companies, involved in that delivery process. It's going to, for some activities, radically change what is the traditional way of teaching, which is what I'm doing here now, standing before an audience. This is what Socrates did basically 2,000 years ago. Stood before an audience and he delivered a lecture. Maybe a better lecture than one I'm giving, but he delivered a lecture. All right, and when I do at University of Chicago, I've been teaching for a long time. That's what we do, and that's what universities and high schools and so on have done for 2,000 years or more, if you go back to some of the more ancient societies. And that's going to continue, of course. That's not going to become completely obsolete. But it's going to be complemented and supplemented, I believe, in a very important way by a new model of teaching, where you'll be an interaction between a student and a teacher. The student may be in Singapore, and we're hoping to get students in places like Singapore and Buenos Aires. Student may be there, and the people delivering the material, whether it be a video, whether it be live, whether it be a question and answer through email type activities, will be maybe anywhere. I mean, nobody will know where they are. They can be anywhere. And I think that's going to be very important. It's going to be important at all educational levels, but I believe it's going to be especially important at the business level at delivering to people whose time is more valuable, who's more difficult for them to go to Chicago, wherever it may be, to get their training. And so this will be, I think, a new business activity, but it'll also be an important way to improve the delivery of human capital at the adult level. I think I'll stop here. I hope we'll have time for questions, and we'll let Gary take on and give you his end of it. Thank you.
Okay. My end of it is probably the right way to characterize that too. But when I was told I had to follow a professor, and not just a professor, but a world-renowned professor in this subject today, and knowing that I'm nothing but a practitioner of practical business, an old cartoon came to my mind, a Charlie Brown cartoon. This got to be 20 years old or so, but it really comes to hits you when you think about all the things that he just said and the few things that I'm going to be saying. Charlie and Linus are laying on a hill one spring afternoon, and they're looking up at the big puffy clouds going over. Charlie Brown says to Linus, "Gee, Linus, what do those remind you of?" And in the next frame, Linus is pointing and saying, "That one looks like Einstein's theory of relativity, and that one looks like the first movement of a Beethoven sonata." And then in the last frame, Charlie Brown, just these bubbles coming up, saying, "Gee, I was going to say it looked like a horsey and a ducky." So my remarks,
all right.
my remarks will be a little bit more. Will be hopefully focused on opportunities. You must know that I'm not a stock picker. When Steve McMiniman asked me to come here today, I thought we were supposed to give you stock ideas. I can't. I don't buy stocks myself. but I consider myself a value builder, a person who takes an opportunity and molds it to build value in companies, and I can apply that, I think, quite succinctly to labor arbitrage on a global basis. I'd like you to think with me about three trends that are really quite obvious, but unless you think about them, I found in the context of today's world, they don't make a lot of sense. When you can put them together, they are free market politics, which is the words that I use in place of globalization, technology, which have different meanings to all of us, and the third one is more than an ample supply of hard currency, dollars, pounds, Deutschmarks, the like, yen even for that case. The first two of these work together to create this opportunity that I see in human capital labor arbitrage. Free market politics, globalization. We had an anniversary last week. I'm sure you all noticed that the anniversary we had last week was the 10 years from the falling of the Berlin Wall. Now, of course, the movement to trade across country lines and boundaries has been going on since Marco Polo, I guess, maybe before that. But somehow that event 10 years ago just kind of focused in on the fact that now we were all going to do everything together. Capitalism had won. And capitalism is trying to trade everywhere. And so that anniversary last week kind of rose again to what's happened over the last 10 years. Now all of the free market politics isn't really free. You won't be confused about that. In Indonesia, free market politics always meant giving the correct bribe to the right person. In China, it meant making sure that the money got into the Communist Party so they remained in control. But that's not the point. The point is that generally the trends go toward more trade across political boundaries. The pact that was signed here just a few days ago in China, while perhaps more symbolic than real, really does point to the fact that people are trying to do more. There are going to be cracks in this free market political world that we're in. Malaysia had to crack down because they would have been overwhelmed by their money problems at that point. China will always try to maintain things inside for a political bureaucracy. The unions in the United States will, I think, kind of fight, but maybe they're giving up a little bit lately to stop free market politics in the global economy from going forward. Now, let's take that and put that together with technology, which makes the labor arbitrage possible. I don't understand technology at all. You guys probably do, but I do know that this morning I was able to punch in a few letters into my car, and it gave me the directions to get here this morning. I know that as a man, having 110 channels on my TV to flip through is a very important part of my psychology. But something happened a month ago that really brought this point right to this thing this morning. I was supposed to be in Singapore to give an address to a group, not unlike yourselves, but people from that part of the world, and a personal situation developed that simply didn't let me do it. Now, if I'd have been called or asked to address a group in Singapore 100 years ago, it probably would have taken me 3.5 or 4 months to go by ship to get there. 10 years ago, it would have taken me 24 hours by plane, stopping over in Narita on the way to get there. But you know how I did this? I sat in my office and I had a TV screen, and they were seeing me in Singapore, and I was seeing them in Singapore at the same time. And I was able to say exactly the same things, probably didn't have much value, but exactly the same things that I would have said in Singapore. And that, was just an illustration of the ability of communication now to make it possible to access skills away from where you physically are at that time. Whether it's airplanes that now go faster and are bigger and carry more things, or ships that go faster and are bigger and carry more things, or satellites that carry things that are now intellectual property, I think you can get the point. So there are three things I think that I put together about the combination of free market politics and the advancement of technology. The first one is make sure your subscription to the OAG is always in order. You're going to be doing more traveling, not less, without regard to this satellite, because unfortunately, our old traditions say we have to be there in person to shake hands. So we'll keep doing that, at least for a long period of time. The second thing is that you will, as investors, see more and more opportunities, because this trend is evolving and will continue to evolve for a long time. The powers of these two things are really enormous. So you're going to see a lot more opportunity. But the third thing, and now we get down to the labor arbitrage capability, is that worldwide businesses will be driven by cost. Now, that's happened in the United States, and I know, because I was part of Jack Welch's team, that in the early 80s understood how the large American companies had to get very streamlined, had to cut down their costs to be able to compete in the world. We were lucky in the United States. We started in the 80s, in the late 80s, and the early 90s. The rest of the world didn't do that. But when now goods and services can be easily transferred around the world, cost will be one of the most important things. And if you can get something done cheaper in another country than you can in yours, and if free trade exists, what are you going to do? You're going to go to the other country to do it. And that's the whole point, really, that I'm trying to say about labor arbitrage. The third major trend that I found when I was with GE Capital was this incredible oversupply of hard currency. Well, why is it? Very simple. Demographics. All of the developed countries fought World War II. Their people came back from World War II, had a lot of fun for the next 2 or 3 years. The population sprung up, and we've been watching this big bubble go through the economy. And they're now at the point where they aren't buying as much furniture as they used to buy. They're buying new cars, but they already had a new car to trade in on the old car. But they're all worried about being 65, and so they're pushing this money in to be invested in a very, very large scale. And what do they want to invest in? Well, not bonds, probably, but that's another subject. We don't want to get into that. So demographics are forcing an enormous supply of money into the system. And what do we use it for? Well, we got enough steel mills now. I don't think we need many more steel mills. Do you, Ron? No, highways are up and the government won't build many more of those. We're developed economies. We don't need that. Today, wealth is being created in intellectual property. And how much money do you need to build a software system? Well, almost nothing today. You can buy all the Microsoft stock you want, but they don't want the money. They got $20 billion of cash that they're sitting on at the moment. So, what's the point about this in a global economy? Well, I think the point is that risk is going to be the issue for an investor. Because in the areas that I'm talking about, where labor costs are low, political risks and financial risks remain relatively high. It is the problem that happened in Southeast Asia. Enormous amounts of money went into Southeast Asia. Great opportunity, let's go at it. Well, Southeast Asia didn't have either a political infrastructure or a banking infrastructure, or in fact our knowledge to be able to deal with that. And so we said, take our dollars. And they said, great, can we pay you dollar interest rates? And we said, why not? We got to get this money someplace. And we forgot all about the fact that they were selling their goods and services in local currency, and when the local currency caught that, I mean, I can't say we, maybe you, I didn't, fortunately, but it was such an easy lesson that had been learned in Brazil and South America in the early 80s, and yet totally forgotten. And I suspect it will be totally forgotten again in the next 5, 10, 15 years, because people just have to get that money to work someplace, and it looks good. Okay, so I have some points that I make about that. I think there's a way to beat that problem of risk in those countries, which I don't think is going away in the near term. The first one is to invest with locals. The amount of knowledge they have is maybe 700 times what knowledge we have, and if they'll put their money in it, you can put your money in it a little more safely. The second thing is to try to buy businesses that are going to be made better. Don't just invest. Now, I know a lot of you deal in public equities, and that's not really the game, but the management of these teams and the ability to make businesses better, I think, will be more important to you. And the third thing is to buy external revenue streams. I'll give you an example. In India, I started a business in India 7 years ago, and it was great. We became one of the biggest finance companies in India. The papers just loved us. Only one thing didn't happen. We didn't make any money. Never made a profit. But the people there were absolutely great, and so we took them and began using them to do services in the United States. And I'll tell you what they did in a few minutes, and this will become more clear. Now, okay, so if the world is going to become more buy and sell across border lines, and if cost is important, and I don't think you'll disagree with me on that, clearly countries that have lower labor costs are going to have an advantage and provide, I think, good investment opportunities. Now, I'm going to give you 4 countries that look good to me. Maybe, may not, but this is my opinion. 2 are relatively obvious. Mexico, and I'll just group together all the Central European countries together. Now, Mexico is, in fact, the 52nd state of the United States today in economic terms. I mean, you go, the most active part of our economy today in production is just across the border in Juarez. You know, you can go to Pittsburgh, it's still building some new buildings there, but it's not that exciting. You go to Juarez, I mean, it looks like Texas did back in the 60s and 70s. Pretty obvious. NAFTA is going to make that happen even further. Yes, that whoosh you hear is in fact jobs going down to Mexico, and there is no reason why that's going to stop. Central Europe is just 5 or 7 years behind that. Their inclusion in NATO gave them a credibility, which, while doesn't help much economically, at least it gave them some credibility. And they are now all being considered and will, in all likelihood, become part of the European community. When they become part of the European community, and you could hire a person in Hungary for an equivalent of $8 an hour, when you have to pay somebody in Germany the equivalent of $50 an hour, I think they'll make a Volkswagen on occasion in Hungary. And I really think that's going to happen over time. 2 areas that maybe are less obvious. The first one is India, my favorite country, if not for business reasons, for other reasons. And technology makes this possible. India has a resource that is as important today as copper was maybe at the turn of the century. It has people who speak English and who are well educated. They have a great educational system that goes back to the British. When they left, unfortunately, the British spoke English. That's another thing they gave us. And so they speak English. And today, those people can do all the service jobs that you're used to doing in the United States. That's what we did in GE Capital. We took those people there and we said, we want you to start doing work over here. And we started by simply having them input information into computers. We'd fill out somebody would fill out an application in the United States. It would be electronically transferred over there. They would type it into the computer program and it would be sent back. Within a year, they began collecting accounts in the United States by voice, sitting in a phone with a phone in New Delhi, and talking to people in St. Louis and Phoenix and Chicago and saying, Mrs. Smith, for some reason your payment has not gotten to us yet. And Mrs. Smith said, well, I just don't understand why that happened. Now, you know, Mrs. Smith probably is used to that accent anyway, so it didn't cause her very much of a problem. There is no reason why the millions and millions of Indians can't do all the things that are presently done by U.S. people that do it sitting from a desk and talking on a telephone. And my final of my top choice is Israel, where the cost of labor is not low, but the value of the brains as it's appreciated in the world is lower than it is in the United States. Because of their armed forces issues, they have developed a great deal of technology which can be applied to commercial activities around the rest of the world, but their difficulty in getting that information to the developed part of the world is what's holding them back. So values are simply better in Israel than they are here for the same amount of human capital. And that's what we're talking about here, and eventually, if you believe my concept and the doctors, that's what's going to happen. Okay, other bests, Philippines maybe because of the language situation, and then I don't find many after that. Frankly, China and Brazil clearly will make goods and export it, as will the NICs on an on basis. Russia, forget it. Congo with missiles is what I've always thought of Russia. I hope not many of you spent much time on it. Think about it. I mean, and that's what it is. So in conclusion, and that's kind of my point, technology and free market politics working together are going to provide an enormous change in where work is done in this world. It can be done anywhere today. Now, that's not, you can't build a house in Poland and bring it over here. So there are some exceptions to that. But large macro elements of the world's economy, in fact, will be done in other places than where they were traditionally done. For you as investors, the opportunity will be there, but so will the competition. And so you will be forced into situations that have a higher risk. As I told you, I think the answer to that is always play with locals. Always look for external revenue streams and do your best to judge the management. So, that's the end of my talk, and hopefully we have time for a cup of coffee.
Gary, thank you very much. Any questions or comments?
Just a couple of things. First of all, one of the things which has affected investors in entities where the people are very important, like advertising firms, investment banking firms, whatnot, is the tranches of the assets. The assets walk out the door in the evening and they don't have to come back. And just one would be interested in your thoughts on that. The second thing is thinking of the initial comments this morning that the education, of course, is part of the human capital. But I think in this country and I guess in certain other locations in the world that it's also what happens when people leave formal education. In this country, people enter an environment of upward mobility and opportunity. And in other countries, that's not necessarily the case, which is why in certain situations you have people with tremendous education, perhaps medical education, driving taxi cabs, because there's more opportunity to do that than to use the education that they received on a formal basis. So there are dislocations. I think Gary's comments about the labor arbitrage are very interesting, and which is why if you call up United Airlines, you could easily be speaking to somebody in Ireland or Jamaica. American Express processes transactions all over the world. Why not? Makes a lot of sense. But just on this, from an investment standpoint, the fact that the assets walk out the door in the evening and don't have to come back, that is an issue, is it not?
Well, I'll just say it's true at the upper end, clearly. The end I was talking about, which is kind of the commodity labor arbitrage, no, it isn't. There are so many people that are unemployed, and as far as you can project, that will be the case. I don't see that as an issue in developing countries. In developed countries, yes, having bought an investment bank and lost a lot of money on it, I can do
Let me make a couple of comments on that. One of the problems that have been addressed in the human capital area a lot, particularly when it comes to company investment and work, is that the company really, and I think this is the issue you're getting at with assets walking out. Companies invest a lot in the workers. Suppose the workers then move to some other company, right? And they've lost all this investment. And that's a problem in any highly competitive labor market, as is the U.S. market and many of the markets in other countries. But traditionally, it was less of a problem in Japan, where the workers couldn't walk out. Now that's changing a little bit. The way that's usually analyzed is to say, to the extent we call that sort of general training as opposed to a company-specific training where it's more useful in the company than it is in the industry or in the economy as a whole, that you try to shift as much of the burden of paying for that on the worker in terms of lower wages, so that traditionally you see workers take very low wages, even if they're highly skilled, and then their wages rise over time. And part of that is they're paying for their investment. At least that's the way we look at it, and then they're getting a return on this investment later on. So that's the way you handle the walkout. Now, in terms of the mismatch between the educational system and the economy, I think that's your other question.
Culture.
Yeah. That really depends upon the nature of the economy, and I agree with my colleague that the free market aspects are very important. What a free market economy does, it feeds back into the educational system, so you get a better match between what's being produced by the educational system and what the economy demands. The mismatch issue usually arises in economies where there's a very strong governmental sort of club over the economy, and where they're pushing, as in the old Russian economy, they had a lot of so-called educated people, but they just weren't trained for any useful jobs that the economy was producing. Market economies handle that problem much better because they get the feedback from the potential earnings in the economy to the kind of courses people take, both in school and subsequently. And so that mismatch problem is much less important in free market economies. And I think you find, very low unemployment rates in the U.S. economy, more in the European economy because of the rigidities in their labor market, that they don't have the flexibility that we have. Still more in some traditional economies where the only good jobs were working for the government because they sort of throttled the market economy, and so you waited around until you got a good government job. But that's a problem in economies where you don't allow flexibility of markets and what I would call the market economy to operate.
With the global economy becoming more open, and I guess the definition of power among countries defined more by human capital than by other kinds of power, what are the implications for immigration laws? It would suggest, if you take this to extrapolate to the end, that the best thing you do is deport everybody into your country.
Why not leave them where they are? They can do the same work no matter where they are. Why bother to immigrate them in?
In that case.
Excuse me?
In some way you have to own that I'm talking about a country. The U.S. has a corporation that owns those people in some fashion, as your firm did in India. But that may be so. But is there some implication of the fact that immigration laws affect human capital?
Well, I'll take a crack at it, and then you can correct me. I think the immigration issue is an important issue. I've been a strong advocate for the United States, if you look at our policies, of having a much more generous policy of admitting skilled workers and so on into the economy, which we have not done. We have certain exceptions for skilled workers, but it's been an economy where we've given preference for mainly other types of immigrants, not for skilled immigrants. So I think the movement of skilled workers, that's the human capital that component you're talking about, should be freer worldwide. Now, to the extent that you get in these other economies, sort of the jobs going to the skills there, to the Indians, software people, and to the Bulgarians who are good at computers and the like, of course, their incentive to immigrate will be reduced. And I think that was the point you're making, because they'll be able to do high-level work there, presumably getting reasonably paid. But nevertheless, there is a great advantage for people who get training to come to the United States, not necessarily, or other developed economies, not necessarily on a permanent basis, but at least for a few years. For example, we train a lot of advanced students in economics. Many of them, say, from Argentina, from Taiwan, from China, from various parts of Europe, literally from virtually every country of the world. Many of them ultimately hope to go back to their own country. If the environment is appropriate and they get opportunities there, they do. But even if they plan to go back eventually, they would like to spend 5 to 10 years working in the United States and picking up all the knowledge that they can acquire working in a company or in the university or wherever it may be in the United States, as opposed to going back. The goal of a country should be to provide an environment, an economic environment, so that it's attractive for their trained people abroad to come back and start companies there, the way it's happened in Taiwan, to some extent in Korea, and in some other places of the world. To the extent these countries don't provide the environment, then the fact that the workers stay in the United States is great not only for the United States, but it's great on the global economy as well. They're more productively used here than they would be in their own country. So I'm a very strong pro-immigration person, but I think if you have a global economy working effectively, you will get a lot of immigration, but some of it will be temporary, that people will come here to get into a most advanced training environment, wherever it may be, but they will ultimately often go back, and we've seen that in many countries now.
Gary, comments?
No.
John?
What would you consider to be the current comparative advantages of the United States, swinging back to the U.S., and the rate of erosion of those comparative advantages in light of commoditization, including technologies, maturing products, processes?
You go first.
The
thing that I have always found the United States had the major advantages wasn't necessarily a traceable human capital element, but one that's more ephemeral. But it's called the entrepreneur, and the U.S. has entrepreneurs times 50 or 100 versus, and not proportionately to the rest of the world. It's been a part of our Wild West, heritage that came along with us, and I think that's an enormous advantage to the United States, and we'll keep this as a country, if you like to think in terms of countries, very strong for a long time to come.
Yeah.
What would you consider to be the current comparative advantages of the United States, swinging back to the U.S., and the rate of erosion of those comparative advantages in light of commoditization, including technologies, maturing products, processes?
You go first. The thing that I have always found the United States had the major advantages wasn't necessarily a traceable human capital element, but one that's more ephemeral. But it's called the entrepreneur, and the U.S. has entrepreneurs times 50 or 100 versus, and not proportionately to the rest of the world. It's been a part of our Wild West, heritage that came along with us, and I think that's an enormous advantage to the United States, and we'll keep this as a country, if you like to think in terms of countries, very strong for a long time to come.
Yeah, I mean, I really agree largely with that. I think, the word comparative advantage, it's all comparative. No country has an absolute advantage in everything, otherwise they'd be exporting and not importing. You can't have any equilibrium with that goes on. Comparative advantage shifts. U.S. comparative advantage is based upon entrepreneurship, efficiency, and the like, and we'll be and do export products in those areas where those type of inputs are very important. And we import goods where basically, less skilled labor and raw materials are important. So if you take Mexico, Mexico has about 75 to 80% of its trade with the United States, but it's both ways. Their 80% or so of their exports are to the United States, so that's why it's the 52nd state of the United States. But also about 80% of their imports are from the United States. It's not equal balance, but they're roughly the same. We're exporting to them the high skill component goods, high entrepreneurial component goods, and we're importing from them, the goods where they're lesser skilled. So jobs have moved down to Mexico, but they've also moved up to the United States. It's been a two-way street, and the net, nobody really knows what the net advantage, if you can, we don't like to talk about this concept in economics of jobs because the economy creates jobs, but if you try to do it in this case, it's probably been a wash, more or less. It's gone both ways.
I had a question for Mr. Wendt and Professor Becker. One, Mr. Wendt, you mentioned two of the three I's, Israel and India. My grandparents came from Ireland, and I was just curious, do you think that is there currently an opportunity for labor arbitrage in Ireland right now? Are we past the cycle? Because the Northern economies have been moving in terms of some of the financial service companies.
You want me to answer that, or you want to give a second?
No, it's your question.
No, you're past the cycle in Ireland. It came and went 7 years ago to 3 years ago. Everybody's working over there now. They had 25% unemployment. Now they had nothing. We started a business in Ireland to do it, and within 6 months said, "Holy cow, we can't hire any people. Let's get out of there." So, but that's good news for Ireland. Ireland is fully booked at the moment. Plus, it's a great place to go. So Ireland's high, but it's not a good labor arbitrage for investment.
And secondly, to Professor Becker, one of the issues that probably surprised many people is the level of underestimation of productivity. putting on your macro hat as an economist, what should we be worried about? Productivity, labor costs going forward. When do we start to worry about that?
Well, the productivity issue has been a fascinating issue in the United States. For much of the time, starting in 1980, we thought we were really improving our productivity enormously, and I think we were. The only problem was it didn't show up in productivity statistics for the economy as a whole. That's partly because, mainly because I believe, as we move much more and more into services in this economy, it's harder and harder to measure what their productivity is. And the national income accounts, economists are not very good at measuring productivity of service sector. I think, however, even with the poor measurement, the 90s have shown what we thought was going on for a longer period of time, a significant increase in productivity in this economy. And the data finally have caught up with, so to speak, the beliefs, and we have been experiencing that. I believe, and crystal ball gazing is not one of my activities, but I'll do a little bit of it now, that assuming, and this is very crucial, assuming we maintain, a reasonably good environment where the government doesn't become too obtrusive with regulation and the like, and taxing, that the productivity potential in the next decade, and I won't look ahead more than that, looks excellent for the United States. As Gary said, we have enormous entrepreneurial talents in this country. By any international comparisons, the number of people start businesses in this country just dwarfs that per capita, per proportion of GNP to any other country that we know about. It's easier to start it here than it is in Europe in terms of regulation. We have people more willing to do it. So I think the productivity potential looks excellent. My only hesitation always has been not on the potential of the businessmen and women and so forth here or in other countries, but on making sure that government doesn't throttle it through excessive intervention and regulation in the economy. But aside from that, I think it looks very good in the next decade.
With our country becoming much less oriented toward manufacturing things, but kind of becoming much more of a service economy, with everybody selling things to one another as opposed to putting products into existence. Does that create, if you decide to think about things on a country basis, does that make our country less stable somehow? Or what are your thoughts on a service economy versus historic manufacturing economy?
No, it doesn't make it less stable. In fact, services tend to be more stable, at least business cycle-wise, than manufacturing. And some people say part of the reason the business cycle is moderated in the United States enormously, starting with the Reagan period. Bush had a recession, but there's been a huge expansion during during the 90s. Part of the explanation is the services are less stable cyclically, more stable cyclically, certainly. No, I don't think any particular problem is created by being in a service economy. As countries get wealthier, they move more and more into services. That's just the fact of life. Manufacturing still is important, but as a fraction, of total employment, it goes down, and we move into a variety of services. Some of them for domestic purposes, some of them that are, have important export markets as well. So stability, I don't think, will be a particular problem. The more difficult problem, as I mentioned earlier, is actually measuring accurately what's going on in the service sector. We can't measure prices very well in that sector, and we can't measure productivity very well. But aside from that very important qualification, I don't think there's any real particular implications for greater instability. If anything, I think it will be the opposite.
It might be helpful to think of the U.S. economy as a segment of the whole world economy, just like we used to think of North Carolina as a segment of the United States. We went to North Carolina because they have lower labor costs. Today, the United States will be the service provider and to the intellectual capital provider, and as the professor said, that's a more stable thing than automobile production.
follow up on the stability issue, though. What about global political stability? Because if I take your scenario and I take also the previous question of the three I's, I think we have sort of, if we extrapolate, then India becomes more of an island and Israel becomes more of an island. You have the English-speaking world becoming a lot more prosperous at the expense of the basket pieces, and the problem I have with the Congo with missiles is the warheads.
And you should have. And I can't answer that. I don't. You're well beyond my capability as a person to understand what to do with that problem. I'm
not asking for the solution, but I'm asking would you accept that your scenario makes the world a little bit less stable?
No, not at all. I mean, you can point to Russia, and if you want to take that as an isolated situation and say, gee, they could blow one off one of these days, yes. But these other countries that are going to benefit from the economy by having a lower labor cost, where the jobs are going to go to, are going to be net benefited. I mean, if you haven't maybe had the chance, I have had the chance to watch politics in India, which is clearly the worst political system in the whole world. I mean, everybody gets to vote. It takes them 3 months. That's just terrible. But you know what? No matter who comes in now, they understand that they got to get the satellite to work better. They don't know about how they're going to distribute milk or anything like that, but they know about the satellite, every single one of them. So no, I think there'll be generally more stability. I just got to take the Russian thing and throw it out because I don't know what to do with it.
It's not obvious, the Russian problem is worse now than it was during the Cold War. I think it's better now. It's true. They have the missiles. They had them then. And there were a couple of episodes we may have been close to being involved in actually in a major military battle with them. So they have a difficult period. But if you look at global stability, political stability, it's very hard to make the case it's worse now than it was in the 70s. The Cuban crisis and a variety of other crises the world went through when there was this greater confrontation between different systems, which we don't have any longer.
Is that because of greater prosperity?
Well, when you rely on trade, when you rely on other people's currency to come in to make your jobs go, you're much less likely to have a war with them, I think.
The people have been more concerned about economic instability through the global involvement. And we had George Soros wrote the book, The Crisis of Global Capitalism, when we had this difficulties in age. He turned out to be totally wrong on that issue. I mean, and he now says he should have called it the triumph of global capitalism because what looked like, Karl Marx had said, used to look at the world, and every time there was a little downturn in one country, said, oh, this is the end of capitalism, this is the crisis, and each time he turned out to be wrong. I think the interdependent global economy that we were speaking about, does mean that some events in one country are going to have some implications for others. But what we showed, I think, in the Asian crisis is an awful lot of strength also in this global economy. So, yes, some economies are going to go through periods of difficulty. Some, like Indonesia, haven't come out of them yet. Others are beginning to come out. But that the interdependency has linkages, but it also provides supports as countries suffer difficulties. And I think this episode that we went through was very informative and, in a sense, very interesting, that it did not lead to a global crisis. It led to difficulties for a couple of years, but difficulties the world surmounted. I think if we look back in retrospect, we'll say they surmounted them quite well.
This is a question about the proportionality of returns to human capital, because it seems that over the last 15 years, if you take a look at the returns to human capital at the high end, whether it's been management compensation, employee management options, the returns to entrepreneurship have skyrocketed during a period when we've had quite moderated returns in terms of median income throughout the country to human capital, which has nevertheless benefited from training jobs, these other things. What's going to happen to that balance, and does it make sense that it will become more proportional, and doesn't that have a lot of implications for wage inflation and also the relative returns to financial capital versus human capital if labor unions start to demand not shorter work weeks and higher labor rates, but more options?
Well, I'll start at the low end and go to the high end. Let's start at the medium end workers. There has been this growing, what we call a gap, or differential is a maybe less loaded term between earnings of people at different skill levels, and what you see happen at the high end is in part simply an extrapolation to the high end of what we see as happened continuously at all ends. So the high school graduate earnings compared to the high school dropout has increased. The older workers' earnings compared to younger workers' earnings have increased. The college graduates' earnings compared to high school graduates' earnings has increased. The high-level workers' earnings compared to the median-level workers' earnings have increased. The top executive earnings, as you said, compared to the somewhat lower-level workers' earnings, that differential has increased. So that's people concentrate at the very high end, and that's probably gone up somewhat more. But this has been a fairly continuous process. Now, as I tried to suggest in my comments, it's in good measure a reflection of the greater payoff to more human capital, whether it's in your position in a business, whether it's your educational training, whether it's your company training. And what it suggests would be is, given this greater payoff, there should be a greater demand to get that training. And you want an economy that can supply that demand through this internet learning that I suggested, through a more direct fact that a much larger fraction of people are going on to higher education now in the United States and in most other countries of the world than were true 10 years ago. If you look at the United States, which we know best, every single group, by male, female, black, white, Hispanic, non-Hispanic, all these groups have been going on significantly higher levels of education than they had even in the 80s. And so as you get more and more of that, of course, that's going to, it's supply versus demand. That's going to increase the supply and sort of moderate the further increases. And in the 90s, we've had a pretty flat gap by skill level and earnings. Most of that increase occurred in the 70s and the 80s. And I think partly it's flattened out in the 90s because of the response to supply that we've been seeing. Okay?
I want to just take a pop at that. Hopefully I can do it quickly. But if the question is, doesn't more of the wealth have to flow down into the system? Under the theory that I'm trying to put out here today, right or wrong, is the combination of free market and technology being able to transfer jobs. The answer says, in the free market world, no, it doesn't mean that's going to happen, because you want more money to do it here, fine, I'll take it to Mexico and get it done, or I'll take it to Poland and get it done. So there will be, since the world still has more unemployed people outside of the United States, there won't be that pressure on the other end. Now, that doesn't mean that there aren't social reasons that we need in this country to do a lot of things in education and in helping those, particularly the minorities. Doesn't mean that at all, but in the theory that I'm giving you now, there won't be any pressure on them.
Gary Wendt, to differentiate the large conglomerate which moves into India and stick in that country where they build and own and operate, I can understand that there's a wonderful labor arbitrage. But going to that other model you described where you're finding a partner on the ground and you're going in and maybe doing a private equity type transaction. Have you seen anybody successfully do that in India where they're able to avoid that other very expensive sort of human capital called graft? Actually successfully implementing it there in India, finding the employees, building it, not overpaying, and not winding up with some embarrassing situation where the government or the politics come in and squash it.
You introduced a lot of specific things as you went down the list. Didn't find graft a problem at all, really didn't. Secondly, didn't find had to pay too much, but that was okay because you couldn't make any money. The general situation in India is very inefficient. It's just very difficult, and not many people have much money. So selling things inside of India is a difficult thing. And the answer is, I don't know who has done well at it. No one in GE had done well at it. But of course, the subject today was labor arbitrage, and on the other end of it, I know a lot of people who've made a lot of money, who have saved a lot of money maybe let's say, by doing their jobs in India rather than in the United States.
If there are no other questions, let me hand it over to Steve for some final comments.
Thank you, Brian. I do have one question. Professor Becker, what's your website?
I'm embarrassed to say I don't know. It's a complicated address. I do have a website. Can be found by looking it up through the University of Chicago Department of Economics.
It's one of the things we do.
Where I outline I summarize a lot of my Business Week columns in there and a bunch of other things.
Okay. What we do, we take the proceeds or today's talk and we blast it out to a lot of people over the email. I'll direct them to your website. But
I can send that to you.
I'd like to welcome some people who are from out of town. Tim Missley from Bermuda, welcome back. Helen Addison from London. Every time Helen shows up, I know HSBC is buying someone. Welcome back.
No comment.
Joe Healy from New York, Highland Search Group. George Shows from Weyerhaeuser. George, you here? Welcome to the East Coast. Rich Bartels from Boston. Welcome. And Tom Cusick from Silicon Valley is a new Greenwich resident and loves to play golf. And with that,
thank you very much. Well, I think we've perhaps developed some human capital today. Professor Becker, thank you very much. Practitioner Wendt, thank you very much. Thank you all for